Accruals. Accruals are the earned revenues and incurred expenses that impact an income statement and balance sheet, which represents liabilities and non-cash-based assets used in accrual-based accounting. For example, accounts payable, accounts receivable, goodwill, future tax liability, and future interest expense. Accrued income. In accounting, accrued income is the income already earned, but not receivable until a specified date in the next accounting period. In investments, accrued income the amount of interest that has been earned on a bond, but which is not yet payable to the bondholder as of the financial reporting date. Asset test ratio. Asset test ratio is an indicator of whether a firm has sufficient short-term assets to cover its immediate liabilities. Also known as the quick ratio, it is more robust than the current ratio, also known as the working capital ratio, as it ignores illiquid assets such as inventory. Companies with an asset test ratio of less than 1 do not have liquid assets to pay their current liabilities. If the asset test ratio is much lower than the current ratio, it means that current assets are highly dependent on inventory. Acquisition. Acquisition is the process by which a company buys another company and controls the resulting venture but does not necessarily exercise direct control. Acquisition expenses. Acquisition expenses refer to the costs that are directly attributable to the production of new business,